All right, so we are at, I guess we're talking about last few concepts related to capital structure. Yeah? And the last class we talked about the degree of operating leverage, degree of financial leverage. Yeah? And let's continue that discussion today. Okay? So degree of combined leverage, it measures the effect of change in sales on EPS. Okay? If you remember, DOL, I think this white chalks are wet. I don't know what happened there. Degree of operating leverage relates to the relationship between the sales and EBIT, right? Percentage change in EBIT divided by percentage change in sales, right? So if something happens, I mean, if there's a little bit of change in sales, whether increase or decrease in sales, what's going to happen to EBIT, right? Degree of financial leverage was the relationship between what? EPS and EBIT, right? So when your operating income increases or decreases, right? What's going to happen to the earnings per share, right? That's the degree of financial leverage. Okay? And last class we learned that this relationship pretty much depends on the fixed cost. Okay? How much fixed cost you use compared to the variable cost. Okay? And this DFL depends on the fixed financial charge, right? Something like interest cost, okay? Fixed financial cost. Okay? All right, so the more fixed cost you use, the leverages go up. Okay? And when the leverage increases, there are positive sides and negative sides, as you know, right? The EPS goes up. You can increase the EPS quickly, right? If you use more leverage, I mean, if you have more debt, and that means if you have more larger fixed interest charge, okay, then that will increase DFL, which means when the operating income increases by say 10%, right, earnings per share can increase by 24%, something like that, right? But on the other side of this the leverage is what? Risk. Okay? It also increases the risk. Okay? All right. So the degree of combined leverage (DCL) shows the relationship between sales and EPS. Right? If there is certain percentage change in sales, what's happening to the EPS, right? And well, based on some, you can derive this equation, this formula, strictly from this formula, right? By substituting, change in sales and actual sales and so on, right? And I'm sure you can do that, right? But quickly, you can figure out, right? So we're talking about ultimately the relationship between the EPS and sales. Okay? DCL, degree of combined leverage. Okay? So we find out that, so that's the percentage change in EPS over percentage change in sales, okay? Which is actually DOL times DFL, right? So if you do EBIT or percentage change in EBIT over percentage change in sales times percentage change in EPS over percentage change in EBIT, right? They cancel out, right? And you are left with exactly the these two relationship, two measurements. Okay, the relationship between the two measurements. Okay, okay. So we find out that DCL is simply DOL times DFL, right? And that kind of bypasses, right, these intermediate steps, and we can look at the relationship between direct relationship between sales and EPS. Okay, all right. That's the idea of the CL, right? Degree of combined leverage. Again, it is an elasticity, right? Because we are talking about percentage change divided by percentage change. That's an elasticity, right? So we have to specify at a certain level, right? Here, DCL at X. X will be a particular level in what? Sales, okay? Right? So we're talking about at particular level of sale, right? You can calculate DCL, degree of combined leverage. Okay. Okay. So here are a few comments about the DCL. A firm can trade off operating and financial leverage to control DCL, right? Because DCL is DFL times, what is it? DOL times DFL, right? So if you have certain desired level of DCL, for example, let's say you'd like to have 6 as a DCL, degree of combined leverage, right? Then you can come up with many different choices, right? You can have 1 for DOL times 6 for DFL, right? Or 2, 3, or 3, 2, or 6 times 1, right? So this is what we mean by trade-off, right? Trade-off between DOL and DFL, right? To achieve certain desired level of DCL, right? Degree of combined leverage. Yeah? Well, what does that mean? So practically, right? What will be the consideration when a company decides, what level of DOL and DFL they're going to use to achieve the desired level of degree of combined leverage, right? We have to consider a couple of things. Increasing amounts of combined leverage increases the risk of financial distress. Okay? Right. Higher DCL implies that either you have higher DOL or higher DFL or both, right? And what's the what's the story about higher DOL? If you have higher DOL, what's the story? Yeah, think about DOL. When you have higher DOL, right? What fluctuates? EBIT, right? EBIT fluctuates by larger amount for what? A given level of sales fluctuation, right? So if DOL is high, what that means is when the sales go up or down, right? Let's say 1%, right? You will see larger fluctuation in operating income. Okay? So again, in finance, what we call variability. What's variable? It's a risk, right? What we mean by risk is simply the variability, right? So when you have larger fluctuation in EBIT, right, operating income, that means we have larger or higher risk, right? Risk increases, right? The same thing here, right? When for certain amount of increase or decrease in operating income, right? When you have higher DFL, right? That means earnings per share fluctuates more, right? Or by larger amount, right? So again, that's another risk, right? So DCL, right? Overall, right? It represents it's a measurement of risk, another measurement of risk, right? DCL, right? Higher DCL, degree of combined leverage, simply implies that there is increased level of risk for this company, right? And the final or last comment here is firms are limited in the amount of combined leverage that can be used in seeking to increase EPS and shareholder wealth, right? So again, the positive side of this leverages, okay, combined leverage or operating leverage, whatever, right, is you can increase shareholders' wealth, right, or EPS, right? But you have to also understand that the risk also increases, right? Well, let's see. Let me make this comment here, right? A firm's DOL, degree of operating leverage, okay, is largely dictated by the type of industry, In other words, what type of industry, what business the company is in. Is it manufacturing or service or whatever, financial or whatever, right? While its DFL is mostly at the discretion, is mostly at the discretion of the firm. Because DFL depends on what? Huh? That's right. On the firm's capital structure. Right? You know, the DFL depends on the fixed financial charges, like interest cost. Okay? So when the company has a higher debt equity ratio, right? That represents higher fixed interest charge, right? And DFL increases, right? So what that means is while the company has choices like this, they can, trade off, right, between DOL and DFL, right? In reality, DOL is largely given. The company has to accept the certain level of DOL depending on what industry the company is in, right? I think I gave you some example debt equity ratios last time, right? GE has pretty high debt equity ratio because GE is in manufacturing business, right? They produce what? Airplane engine, locomotive, right? And all kinds of heavy equipment, right? Airline businesses, right? Also require high debt equity ratio, right? Because they have to lease a lot of equipment, right? And so on, right? While the something like software industry or retail merchandising industry, right, do not require a lot of heavy investment in the equipment or facility, right? So they tend to have low debt equity ratio, right? So DOL is pretty much determined by the company's industry, but DFL is at company's choice, right? So company has a lot more discretion, okay, regarding DFL rather than DOL, right? Okay. All right, so that's about the DCL, the degree of combined leverage, okay? And here we have a slightly different concept, okay? And again, we're talking about the risk, okay? Or actually the determination of capital structure considering the risk, right? And here's one little notion. I mean, we're going to use this concept a little later. Right? We're going to combine this with another concept later. Okay? But think about the probability of negative EBIT, right? Can we find the probability of basically losing money, right, in certain situation, right? So here, let's assume that operating income is distributed normally. Okay? In other words, over the years, sometimes you're going to make a lot of large operating income. Sometimes you make small operating income. Sometimes you lose money, right? Negative operating income, right? But if you can assume that this distribution is normal, has normal shape, right? Then we can calculate probability. Okay? Why do we do this? What are we talking about here? We are concerned with minimum necessary income you have to generate in order to make positive return, positive EPS. Right? So, I mean, think about the fixed cost and variable cost. Okay? Total cost is fixed cost plus variable cost, right? And variable cost depends on what? Output, right? Variable cost depends on output, right? So if economy slows down, economy goes into a recession, and your sales slows down, right? Then, well, of course, your output will decrease, right? And variable cost will decrease. That'll be fine, right? But the problem is fixed cost is fixed, right? And it's not related, it does not depend on the quantity, right? So even when the sales slows down, you still have to pay this cost, right? Fixed cost, something suppose you are leasing a building, right? For your office space, right? And regardless of your sales, you have to make the same lease payment every year, right? Suppose you are leasing truck for your delivery, right? Then again, your lease charge or cost is fixed, right? And money, the borrowed money, right? If you have any debt, right? Debt cost is also fixed. Okay? So considering that, we are worried that EBIT has to be at least as much as your what? Fixed cost. Right? If EBIT is less than your fixed cost, then what happens? Yes, you will generate loss, and your EPS will turn negative, right? EPS will turn negative, right? Okay? So that's what we are worried. That's what we're trying to find out. So considering this minimum necessary earnings level, right? We have certain minimum necessary earnings level, which is pretty much your fixed cost, right? You have to earn at least as much as your fixed cost in order to in order not to lose money, right? Can we actually calculate the probability, right? So yeah, suppose we have certain amount of, in this example, yeah, I guess using this graph, right? The story is the expected level of EBIT, expected level or average level of EBIT is 700,000, right? And the distribution is normal. And suppose we also know the standard deviation. Standard deviation is, say, 200,000. Okay? How do you calculate the standard deviation? Well, assuming we have previous data, right? You've been running this business for the last 20 years. Okay? So based on past history, you can calculate the average and standard deviation, right? And suppose the minimum necessary earning in order not to lose money is, say, 500,000. Right? Then we can calculate the z-score, right? If you have normal distribution with the mean value and the standard deviation, right? Then you can calculate the z-score, right? Z is what? X minus mu over sigma, right? So whatever value you have, right, on a normal distribution, well, let's say this is actually EBIT or X, right? And this is particular X value, Xi. Then you can convert it into standard normal distribution. Okay? Okay. So we're trying to find out how this Xi, particular value of X or operating income, right, converts to a z-score, right? And this is how we convert that Xi value into z-score, right? So, according to this number, it comes out to be what? Well, we don't have actual number, right? Well, that's 5 minus 7 divided by 2 will be minus 1, actually, right? Forget about 100,000, right? 500,000 minus 700,000 divided by 200,000, right? Will be negative 1, right? So we have negative 1 for z-score, right? Then from the z table, you can find this probability, right? The probability that z will be less than negative 1, right? From the z table, right? Yeah, so that's the idea, the probability of negative EBIT. And we're going to come back to this concept a few minutes later, after we discuss EBIT, EPS analysis. Okay? Any question so far? All right. All right. So EBIT, EPS analysis, okay, is a kind of a technique. Okay? It's an analytical technique to be used to help determine when debt financing is advantageous and when equity financing is advantageous. Okay? So, I kept mentioning that there are two ways to raise capital, right? Either debt financing or equity financing, right? And, depending on your situation, right? You can find out that either debt financing is advantageous, equity financing is advantageous, right? But here, there can be actually many considerations, market conditions, interest rate, and so on, right? But here we're purely focusing on EBIT level, right? So holding other things constant, yeah? At a given economic condition and at given market interest rate, right? Depending on EBIT level, we can find out which one is better, right? Between debt financing and equity financing. Yeah? So let's first go to this table, right? This table 14.5. This is another hypothetical example, right? And we have two scenarios here. First scenario is EBIT is $75 or $75 million, whatever, right? In the second scenario, your business is good, right? And you make $125 million of operating income, right? And the top chart here, this is 100% equity financing, no debt, right? So it's kind of unlevered company, right? From the previous chapter's discussion, you can call it unlevered company, right? The plan 2 here is a case of debt financing, right? So this company takes on some debt, right, instead of equity, right? So here, shares outstanding. Yeah. So if you compare this and this, the story is currently the company has 35,000 or 35 million shares outstanding, right? But now they want to raise some capital, right? So they are thinking about, in the first case, equity financing case, they are thinking about issuing some additional shares, right? How much? How many? Or 15,000 or 15 million additional shares, right? So from 35, the total shares will become 50, right? On the other hand, in the second case, right, the number of shares outstanding will be 35, because instead of issuing additional shares, they're going to borrow money, right? They're going to issue some debt or bond. You see the difference? Right? Make sure you understand that story here. So in the first case, equity financing case, number of shares outstanding is 50, right? In the debt financing case, number of shares outstanding is 35. Okay? Okay, so from EBIT, there is no interest cost because there is no debt, right? And EBT is 75, and taxes is 40%, which is 30 million, right? So EAT is 45. If you divide 45 by 50, earnings per share comes out to be 90 cents, right? 90 cents per share. Okay? Well, in case your business is good, economy is in a boom situation, right? And your operating income is 125 instead of 75, right? Then, following the same process, we find out that EPS is $1.50, right? $1.50 earnings per share, right? So, what's the story here? The change in EBIT from 75 to 125, that's 66.67%, so 67% increase in EBIT, right? And because the company did 100% equity financing, right, earnings per share went up exactly the same by the same rate, right, 67%, right. So percentage change in EPS divided by percentage change in EBIT, what is it? Percentage change in EPS divided by percentage change in EBIT. DFL, right, degree of financial leverage, right, is exactly 1. DFL is exactly 1, right? Right? All right. In case they do debt financing, right, then for the same EBIT level of 75, there is an interest cost of $30, $30 million, whatever. So the EBT is 45. So because of the tax rate, because of the income tax, right, your EAT is only 27. Okay? Okay. So in other words, they have tax saving, right? Well, based on that, the number of, if you divide 27 by 35, which is number of outstanding shares, right? Earnings per share comes out to be 77 cents per share, right? Well, if the economy is good, well, the thing is interest cost is fixed, right? Even though your sales is large, sales went up by 67%, right? Interest cost remains the same, right? So because of that, if you go through this process, your EPS goes up to $1.63, which is whopping 111.69%, about 112% increase in EPS, right? So if you divide this by the percentage change in EBIT, DFL comes out to be 1.68, right? 1.68, right? Okay, so here, based on this scenario, you can come up with this graph, okay? And you put the levels of EBIT on the bottom horizontal axis, okay? And EPS on the vertical axis, right? And we have 4 points here, as you see in the previous table, right? We have 75, 125, and depending on what you do, equity financing or debt financing, we have 90 cents, $1.50, 77 cents, $1.63, right? So based on that, we can draw these two lines, okay? In the equity financing case, when EBIT was 75, EPS was 90. When EBIT was 125, EPS was 150. So you can connect these two dots, and that becomes this red line, okay? Equity financing, right? You do the same thing for the debt financing. You find out the line is a little steeper, right? Steeper. And what does that mean? Think about it. Steeper line. What's the implication of steeper line here? Higher DFL, yes, right? In other words, for the same amount of increase in EBIT, the change in earnings per share will be much larger, right? Instead of from here, from 90 to 150, the range is from 77 to 163, right? So you can quickly increase earnings per share if you have debt, or if you go for debt financing instead of equity financing, right? For the same amount of increase in operating income, earnings per share, EPS, will go up a lot quicker, right? A lot more quickly. But what? Risky because think about the range, right? The range is wider, right? What that means is the variability is higher, and that's exactly what we mean by risk, right? Variability, right? Higher variability represents higher risk, right? Okay, so the question here is, at some point, because we have one steeper line and one flatter line, right? At some point, they're going to cross each other, right? If they cross each other, what that means is at that particular level of EBIT level, right, the EPS will be the same. In other words, whether you do the equity financing or debt financing will not make any difference, right? So in other words, you should be indifferent between equity financing and debt financing at that certain level of EBIT, right? That's not really important, okay? But more important here is if you find certain level of that EBIT where you should be indifferent, right? Then what that means is any level of EBIT which is greater than that level, right? You should prefer debt financing. Debt financing is more advantageous because EPS is higher, right? Any level of EBIT which is below that indifferent level, right? Equity financing is better, right? That's what we are trying to find out here, right? So how do we find this crossing point? How do we find this crossing point, right? Well, you use this equation, right? So if you look at this formula, right? EBIT minus interest charge. Mm-hmm. Okay. So that's what? EBT, right? EBT, right? And you multiply 1 minus t, so that becomes what? EAT, right? And then you subtract dp. What is dp? Well, D always means dividend, right? So what is it? DP? Preferred dividend, right? Preferred dividend. If you have any preferred stock issued, right? And then you divide it by ND. ND is number of common shares for the debt alternative in case you do the debt financing, right? So this is the case, earnings per share in case you do the debt financing, right? This left-hand side is simply the earnings per share in the case you do the debt financing. On the right-hand side, you subtract IE from EBIT. What is IE? IE is the interest payment if equity alternative is chosen. I mean, if you do the equity alternative, why do you worry about interest charge? You understand? You got what? What interest? Already? Positive interest? Why? I'm trying to point this out because based on how the textbook presented, right, this chart, it can be confusing, right? Because it says 100% equity, right? Equity financing and debt financing. But you have to understand that we're talking about from now on, right? So at this point, whatever the company is at right now, right, they're trying to raise some additional capital, right? So here it says there's no interest cost, but this is what they're talking about here is marginal interest cost from now on for the next. Suppose they're trying to raise what? $50 million extra capital, right? And if you go 100% equity for that amount, right? Then, of course, there will be no interest cost for that additional amount. But the company at this point may already have some debt, right? So the company may also already have some interest cost, right? So that's what this IE is about, right? interest cost in case the company chooses equity financing? Well, of course, there will be no additional interest cost, but the company may already have some interest cost, right? Does it make sense? Okay, right. So, well, obviously, IE will be smaller than ID here, right? Because ID here will be current interest cost plus some additional interest cost, because they're thinking about debt financing for that additional amount, right? Here, IE is simply existing interest cost, because they are not going to take on any additional debt, right? There will be no additional interest cost, right? Okay, so again, EBIT minus IE will be EBT, right? And then multiply 1 minus T, EAT, and subtract preferred dividend, right? So when you divide that by NE, right, the number of outstanding shares in case you go for additional equity financing, right? So between ND and NE, which one will be larger? Between ND and NE? NE will be larger, right? Because ND is the case of debt financing, which means they are not going to issue any additional equity, right? But NE means from the current level, right, they're going to actually issue more equity, right? So number of shares will increase, right? Okay? Make sure you understand that, right? So you can use this equation and just plug in all the numbers, right? The current number of shares, and for NE, this will be current number of shares plus additional shares that's going to be issued, right? And then the preferred dividend. Well, if the company does not have any preferred stock issued, then DP will be, of course, 0, right? Okay. And then substitute tax rate here and IE and ID, and solve for EBIT, right? Just plug in all other numbers here and set them equal and solve for EBIT, right? Then you're going to come up with the EBIT level where these two EPS will be the same, right? Okay? So that's how they calculated the 100 as the indifference among EBIT level or level of EBIT where you should be indifferent between debt financing and equity financing. Okay? That's what we call EBT or EBIT EPS analysis. EBIT EPS analysis. Yeah? Any question on this? Okay? All right. Well, so let's put these things together, right? EBIT EPS analysis, and previously we looked at what do we call that? Loss analysis, the negative EBIT or probability of loss analysis, right? So here's an example. The story is we have a company which is considering expansion project. Okay? So they will need to raise some additional capital, right? And then, of course, the question is what? Should they go for equity financing or debt financing, right? And let's say currently they found out, according to this chart, right? Based on the history, the expected level of EBIT or average level of EBIT is 500,000 or 500,000. Okay? And the standard deviation is 300,000. Okay? And based on the analysis, EBIT, EPS analysis like this, right? They've calculated the indifference point, the level of EBIT where there should be indifference between equity and debt financing. Right? And they came up with the 300,000. That's how they came up with this $300,000, right? $300,000. That's the level of EBIT where they should be indifferent between equity financing and debt financing. Okay? So here, what they're trying to find out is whether this project is acceptable, expansion project. Okay? And if they go ahead with this the expansion project, okay, the story is, okay, their long-term debt ratio will go up by 30%. Long-term debt ratio will increase by 30%. Right? Okay, so the step one is to compute the future expected level of EBIT, again, based on the past history, or you may consider any other information available, right? And you can calculate, in addition to the past history, you can also consider the future projection, right? I mean, if the consensus is next couple of years economy is going to be really good, right? Then you may be able to slightly increase the expected level of EBIT, right? And so on, right? And then estimate the variability of this EBIT based on the past experience. Again, we're talking about standard deviation, right? So you need to know the mean and standard deviation of this distribution. Okay? And then compute the indifference point between the two financing alternatives, right? That's when you use the equation, right? And solve it for the EBIT level, right? And analyze these estimates in the context of the risks the firm is willing to assume. Okay? And here they mention two different criteria. Okay? One is indifference point criterion and loss criterion. Okay? So if you read the chapter, their risk, I guess, appetite, I can say appetite, right, is they're willing to accept a 25% chance that they make a mistake in the financing choice. You see what I'm talking about? Okay. Through the EBIT EPS analysis, they're going to calculate this particular EBIT level of EBIT where you should be indifferent. In other words, if EBIT is above this level, then you should choose what? Debt financing, right? If it's below, you should choose equity financing, right? But of course, there is a chance that you may this number that you calculated turn out to be incorrect, right? And that means if you use this number, you're going to make a mistake, right? And according to the story, the company is willing to accept 20% chance for that mistake, right? That's their risk appetite. Right? And then they have another risk condition, criterion, okay? That is, they're willing to accept 5% chance for losing money or negative income. Okay? So based on this distribution and assumption, assuming that this EBIT is normally distributed, okay, and assuming the expected level of EBIT was 500,000 and standard deviation was what, 300,000, okay, you can apparently that's 200,000, right? This number is hard to see, right? So you can calculate that probability, right? So first probability is calculate the z-score, right, as 300 minus 500 divided by 200, which is negative 1, right? And from the z table, from the z table, you find out that if it's negative 1, if this is mean, let's say negative 1, this is 0.1587, 0.1587, right? So probability that z will be less than negative 1 is 0.1587 or 15.87%. Okay? So what's the story here? They found out this is 300, right? And the probability that actual indifference point will be less than 300. Yeah, if it's something like 100, right? Then 100 minus 500 divided by 200 will be actually negative 2, right? So the probability that the actual indifference point is actually below 300, right, is 15.87%, right? Yeah? So the probability of making a mistake is 15.87, but the company is willing to accept 25% chance for that risk. Okay? So based on that criterion, the project is acceptable, right? That's the story based on that criteria. Okay? And then the second story is what? If you read the chapter, apparently the minimum necessary EBIT, minimum necessary operating income level is 100. Okay? So in order to cover the fixed charge, in order to pay the interest cost and all the fixed cost, operating income has to be at least 100, right? So then you can calculate the z-score for that, what we already did here, 100 minus 500 divided by 200 is negative 2, right? So probability that z will be less than negative 2, according to the z table, it is 2.28%. So here if it's -2, right, then this probability is on 0.0228, right? 0.0228, right? So that is 2.28%. Okay? But according to the story, the company is willing to take 5% chance for losing money. Okay? So since this risk is even lower than 5%, right? The project is what? Again, acceptable, right? Based on the criteria, based on the condition or requirement by the company. Okay? That's the story. Right? So that's just one example of considering the EBIT EPS analysis and this probability consideration, right? And bringing those considerations into your decision, right? Whether you should do the project or not, accept the project or not, right? There should be some other, okay. All right, we have a couple of more concepts here. Let me just mention one more thing and let you go today, okay? All right, so step 5 here, that's the last step. Examine the market evidence to determine whether the proposed capital structure is too risky, right? So what that means is even when the proposed project proposal passes the scrutiny or condition or evaluation, right? You also need to consider some other factors like market condition, right? Or market evidence, right? In other words, as I mentioned, they find out that if they go ahead with this new project, their debt equity ratio is going to increase by 30%, right? And you have to compare that to other companies in the same industry, right? And see if your debt equity ratio will significantly exceed, right, some normal debt equity ratio in the same industry, right, of the average debt equity ratio of the companies in the same industry, right? So, if it's too large compared to the normal, what's considered normal, right, then you may rethink, right, or think twice about actually going through with this project. Okay? That's what this means. Okay? All right. What about the stock price? Okay? EBIT, EPS analysis and stock price. Okay? So when the company takes on certain capital structure, right, that's going to determine their EPS, earnings per share. Right? So normally, when the earnings per share increases, that's a good sign, right? Because it happens when the company makes more profit, right? So, when the company announces their earning, right? Usually the stock price responds or reacts immediately, right? Every 3 months, the company announces their quarterly earning, right? And based on that, you can calculate EPS. And if EPS went up, then the stock price usually goes up, right? However, there is what is called the PE ratio, right? Price-earnings ratio, right? And price-earnings ratio, as you know, is stock price divided by earnings per share, right? Stock price divided by earnings per share, right? So what that means is actual stock price will be PE ratio multiplied by EPS. Right? And who determines PE ratio? Okay, because market price is actually determined by the market, right? So that is the correct answer. P/E ratio is determined by the market because, P/E ratio is simply the price divided by EPS, right? EPS is determined by the profit condition, right? How much money the company made, right? And so on, right? But the price is determined by demand and supply in the market, the stock, quantity of stock, right? So that is P/E ratio. And depending on P/E ratio, the price can adjust again, right? So what that means is when the P/E ratio comes out, suppose P/E ratio comes out to be 20, right? And what that means is current stock price is 20 times higher than earnings per share, right? And if the investors think this is too high for some reason, right? If investors think this is too high, right, then what they're going to say, this stock is too expensive or overvalued, right? Too expensive or overvalued, right? And what that means is demand is going to go down for that particular stock. Supply is going to increase because many investors will try to sell or dump this particular stock, right? Then what's going to happen when the demand goes down and supply increases, right? Price goes down, right? From the initial price, price goes down, okay? So that's what we're talking about here, right? Normally, price is positively related to EPS. When the EPS increases, price should increase, right? But there is something called the P/E ratio, right? And depending on what the what the market considers normal P/E ratio is for this particular company, usually it's for particular industry, right? So if it's manufacturing industry, right, or well, actually I take it back. It could be for each individual company, right? So even among all the firms in manufacturing industry, back in the days when I was trading, right, GE stock, I use GE example a lot because I used to sell, I used to write option, okay, on GE stock, right? So at that time, market considered about 16 is about the right P/E ratio for GE stock, right? So even when you compare the manufacturing companies, the companies in the same manufacturing industry, depending on the debt equity ratio and all kinds of profit perspectives and the risk and so on, right? The analysts assign different P/E ratio to a different company, right? Okay. So yeah, there is what's called the P/E ratio. P/E ratio again depends on the market price, right? But it can also affect the market price, right? Did you get it? Did you get what I said? Right? Once the EPS is determined, P/E ratio is P divided by EPS, right? So P level of price determine P/E ratio, right? But based on what market considers what the desirable P/E ratio is, right? It can also change the price, right? If market considers 15 is the right P/E ratio for this particular company, but based on current market price, it's 20. right? Then it's going to adjust, right? Investors will think, well, this is just too expensive, right? Needlessly high prices, right? So they're going to dump the stock, right? And it's going to adjust, right? So considering that, you have to pay attention to the P/E ratio, right? And yeah, the second comment, we talked about it many times already. Yeah? You have to consider the trade-off between the earnings, increased earnings, and increased risk. Yeah? All right, any question? We're going to finish this chapter quickly on Tuesday, and we're going to go to the next chapter. Okay?